Salutations and good vibrations, everybody. Welcome to Financing with Bedrock Business Builders and Joe DeChara. We're going to talk about a ton of different ways to get financing, to learn about money, to make it so we're organizing our accounts, and really ways to either think outside of the box or really to act within the box of financing. Because a lot of times you do have to cross your I's and dot your T's. Wait, it's dot your I's and cross your T's
I do
when
the
you
same thing.
when you are looking for financing. So we're going to really take away some of the secrets to the type of forms that you have to file, and even the type of institutions or different people you have to engage with. We do have some guest speakers. We've got lots of intriguing information. And Joe, I'm just going to let you take it away because I don't want to share all of the things that you're going to share, and I'm sure I'll interrupt you in between. Okay.
Yes, you're great at interrupting me. Hello, everybody, and thank you for joining us today. Tomorrow's my birthday. If you wanted to know, I will put my address in the chat so you could send me some brownies or whatever. I know my team at Bedrock sends me brownies. Sometimes they don't actually come on time, but I know that they're coming, right, Elizabeth? I'm looking forward to those brownies.
They're still good when they come a little later, Joe. Don't you worry about a thing, okay? We cannot control the post office. And this is where a lot of times when we're applying for financing, we also can't control the banks or the people who are looking at our documents. It takes a little bit of time. So patience is a virtue, and we're going to rock it.
Yes, thank you. So, a lot of this has to do with financial literacy, and it's not a coincidence that we have our friend Rhonda Klitsch on today. She will be talking to us about credit and some other things, but really, it's kind of shocking, the stories that I hear, actually the things that people don't know, seasoned business people, they don't know about a lot of the things that we're going to cover here. So I don't take anything for granted anymore. I don't assume anything. So some of the stuff is going to be basic financial strategies that you may or may not know. I like your strategy, Elizabeth, of, what is it? Time out? Not time out. You give it time, right?
Yeah, you just give
Right.
it time. You take a breath. You don't rush things. In fact, time makes it so time tells all now, doesn't it? So if you're able to put the effort forth to do what you're going to do, and then other people don't necessarily respond or things don't work out as planned, it really gives you the ability to pivot, or it gives you the ability to do something else. So rushing things, haste makes waste, right?
Yes,
You don't
we're gonna
necessarily want to rush.
we're gonna talk about that because that is part of the strategy. So who this is for, I believe that if you're here, it's definitely for you. It's for anybody. You don't even have to be in business. A lot of this information is for regular folks going for mortgages. It's about learning about money, the
But Joe,
different ways.
do you have a slideshow? Are you you're not
Yeah.
sharing your slideshow?
Oh, I'm sorry.
I know I need the visuals. Like, we're gonna talk
I
about
thought
who
you
this
were
is
sharing
for.
it. I thought, okay.
No, you're totally gonna share it. You're in control, Joe.
Okay, here we go. Can you see that? Oh no, I got the wrong screen up
We
there.
can see it. We can see your notes. I don't know. I don't think that's the one we want.
No.
There we go. Victory is ours. This is where you can make mistakes and you can still fix it.
Okay. Technology. One thing, if there's a given, it's that technology will go off the chart, even if it's me, or I should say, especially if it's me. So I already said who this is for. This is for anybody that thinks that knows that they don't know. Okay. You're going to leave with you're going to leave with more information, some surprises. You're definitely going to leave a little bit smarter than you might already be. Definitely actionable steps that you could take. I always like to leave our people with stuff that they can actually start doing now, not just, oh, that was a good workshop, and when I get to that point, I'll use it. And this is why you should stay, because first of all, it's not going to be a long drawn out workshop. Rhonda said for some reason that this was 2 hours. I don't think we're going to go 2 hours unless you want to. We will stay for questions and answers, and uh, that's always pretty interesting. I like getting questions, mind-bending questions, right, Elizabeth? And so if you don't know me, I think most of you might know me. If you don't, you might be wondering, who am I and why am I here? What makes me think I could teach you? Well, because actually it's over 45 years. I think 35 years I've been a CPA, which is kind of scary. The time really goes by quickly. But in that time, I've actually literally worked with thousands of business owners. And hopefully I'll be working with thousands more. That's what I look forward to. And in a nutshell, what I've done is I've always looked at people's operations, helped them streamline their business in the process where I'm actually tricking them into creating books and records and trying to help set them up for success. And real success is not having sales, but having cash flow. That's what we're always talking about. If you don't have cash flow, you're doing something wrong. Maybe you should be in another business. So let's start with the actual content. The first question is, do you really need financing? Okay, a lot of times we want something, but we don't actually need it. So how do you determine wants versus needs? Number one, if you think it's going to make you feel good, that's not a good reason. If you see other people have financing, that's not a good reason. If it looks cool, if you're like, oh, I could use a lot of money, and if you think it's going to help solve your problems and take your business to another level, you're probably wrong. Okay, there's a time and place to go for financing. Okay, and we're going to help you determine exactly when that is, how to actually determine what your needs are. Okay, one of the options that I always use is I like to ask people, what do you think? And Elizabeth was just talking about taking time, don't rush into it. The other thing that you have to consider is the cost of money. You know, money costs money. Banks are in business to make money. And what you have to ask yourself is this a good cost or a bad cost? In other words, there's good financing and there's not good financing. Okay, later on in the presentation, we have a guy that we recently met, Logan, and he did a video. He couldn't be here today, but he talks about good financing and bad financing. So that's important to know the difference. So how do you determine your needs? Okay, the first thing is you want to have, and this is just good business practices. You want to have a business plan. Okay, now I'm not talking about the 200-page business plan I did about 15 years ago. Right now, I should be on the whatever list Warren Buffett and Elon Musk are on it, if my business plan actually worked out the way I had planned it. But you need some sort of plan. You need an objective. You need a vision. And you have to put that in writing. Okay, having your business plan in your head it's not worth the paper it's printed on, to be honest with you. Also, your plan will probably change. The details will change. What I suggest is that you have a vision, and whatever that vision is, that doesn't change. Okay, unless you find out that you've changed. Maybe you have changed your vision. But my vision of my business hasn't changed in 20 years. What we're doing with Bedrock right now, I wanted to do 20 years ago. I couldn't, it didn't happen the way that I wanted to because I had missing pieces. Okay. And how did I find out what I was missing? I started asking people. Okay. One thing I knew was the last thing I needed was to borrow money. Money was not going to solve my problems. I didn't need the money now. Right now, we're probably at a point where we can use financing. And I'm going to tell you about what kind of financing, because there's different kinds of financing. You got to ask yourself, why do you need this? When are you going to use it? What'll happen if you don't get financing? What's going to happen if you don't, spend $25,000 on a new website? Is that going to hurt your business? So you got to ask yourself these questions. Okay. These are some of the reasons you want to grow, you want to get financing. If you need it to grow, okay, and we're going to talk about my own situation here with Bedrock. We may be looking to buy other accounting and tax practices. Well, we might need to get financing for that. Working capital. Okay, if you don't, so like in the construction business, a lot of times I've had clients that were making plenty of money, but they didn't have cash. Why? Because the cash gets eaten up by their jobs. They have to lay out, 20, 25% for materials, and they got to pay their workers. And if you're growing, that's the kind of business where you run out of cash. And if you run out of cash, you run into all kinds of other problems. Okay, so you need working capital to run your business. You might need equipment. Okay, I've had people in the trucking business, one of those big trucks costs about $200,000. Well, one thing you don't want to do, even if you have $200,000, is use it all on equipment. So that's one of the things that it's good to finance, because you don't want to use all of your cash. So you will want to get equipment financing. Another thing is if you're renting a brick and mortar place, instead of paying rent, you want to buy the real estate. I have a friend, he owned a gas station. Okay, what he realized was he bought the real estate that his gas station was on. And what happened was, instead of paying $10,000 a month in rent, he paid $5,000 a month on a mortgage. Okay, so his actual cash flow went up. And after 30 years, now he owns the property. And then once you own real estate, you can use that to leverage. That's another way to get more financing. Your real estate hopefully is going up in value. So that's another reason to raise capital. Elizabeth, if you have any ideas or suggestions that I haven't included here, feel free to.
Well, so far in the chat, I've added our business plan template. I've also added the startup business checklist. You're going good with the idea of why we need financing and who we can reach out to for financing. You don't want money just sitting in a bank. So I have to admit that I had a conversation with somebody recently who said that they took out a loan and they didn't use it. They were just letting it sit in their bank account. And when they said that to me, I thought, what are the benefits of having just a bunch of money that you're paying for sit in your bank account without it actually making money for you?
I could
Because it,
tell you why.
why, Joe?
Because it makes them feel good. That was one of they think that they're, but there's an alternative to that. There's another way to get financing and not pay interest on it. And we'll cover that. But that's a good, I've seen people do that plenty of times. I've seen people, I'll tell you a couple of stories. Back about 30 years ago, there was a bank, they're no longer in business, and I understand why. They were giving people up to $100,000 lines of credit based on their credit score. Okay. They didn't need to give tax returns, financial, all they, well, you had to give them your personal tax return, but it didn't matter. It was all based on your, if you had a good FICO score, they gave you the line. Okay, I had a couple of clients, and this is why I stopped getting people loans. A couple of clients that had no business getting money because they didn't need it. Okay, but these were lines of credit. Okay, there's, and we'll talk about the difference between a line of credit and an actual loan. But they got the money. One of them was never in business before. It was their own, it was their first business. They had a lot of learning to do. And I don't even think they actually went into business. They just had a lot of ideas, and they started spending money on things like websites and stuff that they really didn't need. Okay, so
Mm.
that's why I stopped getting people. I was doing a lot of it, and then I just stopped because I didn't want to uh, help people waste money, if that makes sense.
Well, yeah, if you're seeking out financing, you want it for a positive purpose, right? And there has to be specificity with it. I think that that's where the banks and different lenders are more likely to actually give you financing. And lenders who are just going to give you financing just to give it to you, well, maybe there's a catch to it. And you have to make sure that you're reading the contract clauses that you're signing when you take out that money. What are they actually looking for you when they give you money? What's the interest rate on it? What is the caveat to them lending you those funds?
You know, Logan brought up a great point because Logan's in the real estate business and he's got a lot of cash flow. He's got a big real estate empire. And what he likes to do is he likes to pay off the loans and get better financing. It has to do with how he manages his cash flow. So what he found out is he doesn't get loans that have prepayment penalties. Okay, so that's one of the things you want to do your due diligence. Okay, you know, you do have to read the fine print. You got to know exactly what kind of loan you're getting. And if things go good, if you want to prepay it, that you're not paying extra. Okay, I had somebody, I had sold my CPA practice a long, long time ago. I wanted to get out of the CPA business. And the guy that purchased my practice financed it, and he couldn't pay. The bank told him, yeah, you could pay it early, but you're still going to pay us all the interest. So he had a 5-year loan. If you paid it off in a year, he was still paying 5 years worth of interest. So that's a good point. Now, alternatives to financing, before you go out and get money, you got to make sure that you're squeezing out all the cash that you can from your business. And this has to do with budgeting, with managing your cash flow. You know, we're looking on a regular monthly basis. I'm looking at our P&Ls and saying, that is there anything we're paying for that we don't need, or are there alternatives? We just changed our social media posting from paying $50 a month to paying $39 a month. That might not seem like a lot, but you do that over and over again, and that money adds up. Also, you do want to have a cash fund. You want to have at least 6 months worth of capital just in case, or I should say, when cash flow starts drying up. And not because it does for a lot of reasons. If you're growing, if you want to hire new talent, uh, so you want to have that extra cash in the bank. Imagine and COVID was like a once in a generation thing. But there were other financial catastrophes. 2008, we're always facing unknowns. So you want to have some cash in the bank. Okay. Another alternative to financing is your payment terms. Okay. And we talked about this a couple of workshops ago. When we're talking about just cash flow, maybe you don't need to get financing. Maybe you just change the terms of your client. You try to get money up front. Okay, instead of waiting for your money, instead of billing them at the end of the month, bill them at the beginning of the month. When you do that, even the ones that take 2 weeks to pay, you're getting your money a month earlier. That makes a big difference. And on the other hand, when you're paying bills, you want to get terms from your vendors. Okay, a lot of time, especially in the construction business, you want to create your own credit outside of your social security number. So these are alternatives to financing. Even if you go to you can get a Home Depot card. That's financing that doesn't require financing. They're just going to give you the ability to buy stuff, which is what you want. Now, at this point, we are going to bring on Rhonda because being prepared before you even start with these other things, you got to look at your credit. Okay, so can you, what do I have to do? Do I have to stop? I have to stop sharing, right?
You can stop sharing, Joe, and then we'll see just Rhonda. I don't think she needs your slideshow.
Okay. Can you spotlight her?
She is spotlighted. In fact,
Oh,
you,
okay.
me, and her are spotlighted. I can take our
Oh, okay.
spotlights away.
Okay, awesome. Hi, Rhonda. So Rhonda is the owner of Equity First. She's one of our new best friends. And you are the expert on financing and credit. So take it away, Rhonda.
All right. So thank you so much for having me. So like Joe said, my name is Rhonda. I am the founder of Equity First. And since 1996, I have been working with small businesses and consumers in financial distress. So my whole purpose is twofold. It's taking the people that have had a financial challenge and making sure that we make them whole. And then the second would be the preventative, right? Looking ahead and forecasting what may go wrong down the line and offering consulting services to make sure that people are making educated and smart decisions. So very similarly to what you were just talking about, I'm listening to you speak about the financing and financing alternatives, and it makes a lot of sense. I think people just need to process that for themselves singularly, not as a whole. So where a lot of times I'll have recommendations for a client, it's not a one size fits all. So oftentimes we're spending time working through the challenges with each individual client. But for the sake of our conversation today, we want to speak about being financially healthy and knowing that without making the appropriate choices that you were speaking about, all those options and alternatives that Joe just mentioned means nothing because you're not putting yourself in a position to qualify. So when you are doing renovations and you are looking at getting that Home Depot card because you purchased real estate and you don't want to really take out a $25,000 loan, but you can get a $25,000 line of credit from Home Depot, you still have to be able to credit qualify. And that's really the basis of the heartbeat of everything that we go through in America and our American culture and society to make that decision. So a few things about credit on the personal side, and we'll speak about personal and on business. So on the personal side, you have two people, the people that are deathly afraid to take a look at their credit and those that are proudly checking their app every day, right? So it's one extreme or another. Rhonda, I have a 720. How do I get a 780? Or I'm afraid to check because of the fact that I know that there's been some hiccups. So we'll start with the people that are financially healthy, or we should say credit healthy. It's smart to check and subscribe to any service. Most of our credit cards offer it for free. We recommend our clients to go to Credit Karma and Experian. This way they can monitor it. And even if you know that you're not a credit abuser, what's nice about having these free access, resources is that they'll alert you if something is happening. So for example, if you have great credit and you're very credit focused and you recognize that your app sent you a message that there's been a change or there's been an inquiry, these are great tools for you as a consumer to make sure that you're then logging in to say, I don't remember authorizing Citibank to run my credit, or I don't remember authorizing this company. So it's just a good way for you to stay on top of activity. And what I always tell people, do not get focused on the score. The score and the data change all the time. So again, if you are somebody that has a high credit score, you have good credit, do not get focused on your credit score. It's really about the data. And most importantly, we try to make sure that all of our clients that have good, healthy credit have 3 to 5 active trade lines. And that's a combination of what we call revolving and installment. So if you have a mortgage, a car payment, a student loan, and 3 credit cards, and everything is being paid on time, you should look like a rock star. You will see a decrease in your credit score if you are a credit abuser. And that's just somebody who is frequently utilizing every single month their lines of credit. So if you have small lines of credit, such as $500 or $1,000, it's very easy for you to make one car repair and see that your credit will decrease 50 or 60 points because you maxed out that credit card. So just keep in mind that your credit and looking at the algorithms and the way that they work, again, for somebody with good credit, just pay attention to your spending. If you think that you are going to need more credit beforehand, go ahead and apply for another line of credit. It will keep what we call your credit utilization down. And again, just as to give you like a quick analogy of what that means, if you have 5 credit cards and they're each $1,000 each, but you know that you want to have an in-ground pool put in, and even though you got financing for the pool, you want to buy all your outdoor furniture and you want to buy, a bunch of things, and you're going to spend $3,000. Well, you've now, in theory, you are over 50% utilization on those credit cards. You may want to consider opening another line of credit just so that your overall utilization is kept lower. And that's if you are somebody that is completely credit focused on score only. Again, when clients come to us, we're not always looking at score. We're looking at the data and how we can manipulate the data to giving you a higher score, but keeping your credit healthy means keeping your balances low. And again, therefore, if you have to spend somewhere, you may want to consider opening another line of credit just to keep your overall utilization low. In relation to clients that we see that have bad credit and they're afraid, right? So the good news is that you have people like myself that will give you a free consultation and an action plan and tell you what you need to do to overcome those challenges. So oftentimes what we see are clients with low scores. And people generally don't wake up in the morning and say, today, I don't want to be responsible for my debt. There's generally been a life event that was a trigger, a death, a divorce, taking care of an elderly parent, a sick child. Maybe they made a poor investment choice. Maybe they brought on a bad business partner, right? So all of these things are what we deem as life events. So somebody didn't wake up and say, I decided to bang out my credit cards, $25,000, $30,000, and wake up on a Tuesday morning and decide not to pay it. There's usually been a trigger. So in scenarios like that, we work hand in hand with the client, and it's important to assess what is happening. Is it a debt problem? Is it a credit problem? And where do you start? you start by looking at your budget. So if you know that you have an exorbitant amount of debt and it seems like it will be forever for you to pay that debt off, you know, I hate to say it, but sometimes we'll just recommend to a client a bankruptcy because that's meant to have a fresh, clean start. And just to give you an example of what that looks like, if somebody came to me and they had $30,000 worth of credit card debt in default, but I sat with them and their budget only allowed for them to maybe pay about $100 to $150 a month towards that debt. Well, even if I got them 50% settlement offers, that's $15,000. It would take them years at $150 a month, putting that money away to pay off.
They'll never pay that off.
No, and you're at risk of being sued by any one of your creditors. So in a scenario like that, when we sit with the client, again, it goes back to the budget. So credit and budget go hand in hand. And it's specific because you want to make sure it makes sense. So if $30,000 was their, their debt, and they could only apply 150, we would recommend bankruptcy. 90 days later, they are debt free. And we would help educate them towards saving the 150 a month that they would have used to pay off those creditors. And we teach them how to reinvest it back into themselves, right?
Okay,
So that they have an emergency fund.
Can I ask you, I know that you have to leave, so I want to let everybody.
No, go ahead. I have until at least 2, that's
Okay, but
fine.
I'm coming up with a lot of questions and
Go
I
ahead.
can't, so I want to cover them as you bring them up. And if
Sure.
anybody else has any questions, either
They could throw it in the chat. That's fine too.
throw it in the chat for now.
Mhm.
And Rhonda, did you put your contact info in the chat?
I did.
Okay, great. So let me go backwards. You talk about debt settlement.
Mhm.
Okay, so you could, so how you offer that and how does that
We
work?
offer that as a service to clients. It's part of our overall plan. As a company, we're structured as a consulting company. And anytime there's anything that revolves around debt or legal matters, we have 2 in-house attorneys that are staffed with us.
So now if I got 50% off on my credit card, would that affect my credit?
What would happen is, keep in mind, you would need to be in default before you can settle. So
Oh,
the
God.
damage to your credit is already been done. If you settle, it will be marked on the credit report, settled legally for less than full balance. However, because credit is something we specialize in, depending upon the creditor, there are often times that we can negotiate directly with the creditor for what we call settle for delete. And what that means is
Oh,
that
wow.
they will actually permanently delete the entire account off the credit report in exchange for us making that payment to the creditor. So
Wow.
anytime we could wipe away, right, or completely reverse any negative effects that will overall increase the credit score. But we also want to point out that any type of settlement over $600 in savings is subject to a 1099-C.
Oh,
So
I was
right
going to
back
bring
at
that
you.
up. That's one of Elizabeth's favorite 1099s because we're getting more and more people with those. And I don't know if
Yeah.
it's because the credit card companies are under pressure from the IRS. I have a feeling that that's what it's from. In fact, we had a couple of people that did something. Oh, they had mortgage
Mortgage
relief.
cancellation. Those are usually
Yeah.
for second mortgages.
Yeah.
So that was very popular in probably like 2010, 2011, after
Yeah.
the market crashed. If you had a second mortgage and there was no equity in the property in second lien position because of the fact that the market collapsed, a lot of the lenders received money from the government, and the Department of Justice, actually would wiped out from the DOJ people's second mortgages. So what would happen is that they actually were zero balance, but they were 1099. So you still, as a consumer, had to claim that loss as income on their tax returns unless you were able to show insolvency, right? So that goes back onto
Right. So
onto
there
you.
are exceptions and it gets
Correct.
pretty muddled, but it's not always, so you'll get the 1099 C, but you don't always you have to report it, but you have to also tell them, oh, I qualify for one of these exceptions.
Also keep in mind that just because you have a zero balance letter does not mean that they filed the appropriate paperwork to actually satisfy the lien. So the
Oh, wow.
lien is done through the title company because it's specific to real property. So even though the mortgage company discharged your debt and obligation and sent you the 1099, it's so important to make sure that those customers or clients go back, they do a property search to make sure that the mortgage lender correctly satisfied the lien and that the lien release was issued in reference to that particular lien.
Interesting. Now, do you need a lawyer for that, or can you do
No,
that?
you could do it directly through a title company.
Okay.
It's public record.
Couple more questions. So
Mhm.
you talk about budgets. That's my thing, because when businesses start, they never have a budget.
No,
People have household budgets when they come to you, or are you educating them on this?
it's a combination. A lot of times people don't recognize the bleed until you point it out. So for example, if I'm sitting with a client for the first time that is coming to us because of a budget problem, again, they could have perfect credit, but they're just making minimum payments every single month. And
Overextended.
right, and they're overextended, so they'll come to us and we speak about the budget. I require them to get a debit card and start really putting all of their spending on debit. That'll give me a bird's eye view of where they're spending their money. And most often it is on things that are what we call unnecessary. So the best example I can give you is people that drink coffee. They love to go to Starbucks. They may go twice a day. That could be $10 or $12 a day. So that could be $200+ a month. And I have to explain to them that the barista is only nice to them because she's paid to. There's no personal relationship, even though she knows your name is Jenny or your name is
But
Bob. They
now
feel this
you're-
personal connection, but they're paid to be nice and provide service to you. They're not really there. Same with the deli in the morning. You want to stop into the deli or the bagel store. There are ways to cut back, and there are little tips and tricks that we offer to our clients when they are budgeting, I should say.
I got to start sending our budget clients to you, because it's pain. When you ask somebody to change their habits, it's painful.
Mhm.
So two more questions, and then I'll let you go on. I'm getting a lot of emails, or when I go on to my Credit Karma, they're telling me to add my bills, like my monthly utility and cable bills, and they're claiming that it's going to increase my credit score. Is that true?
It can be for some people. Those are called alternative lines of credit. So we've all seen at this point commercials for Experian Boost. So that's
Right,
really
right. That's what it is.
So Experian Boost offers a program for people that have limited credit. So somebody that may have one secured credit card or maybe no credit, they've always used debit cards. Maybe it's somebody who's younger or
Right.
just prefers to work in cash. Now all of a sudden they need to, purchase a car or buy a home and their credit is limited. So what Experian Boost does is they allow you to connect your bank account. And what they'll do is they'll look for things that you pay on time every month, such as cable, maybe a gym membership, your rent, could be a cell phone bill, could be a doctor bill, could be anything, right? You pay the orthodontist every single month. So what they'll look for is consistency, and then they'll utilize that and add it as a line of credit. And if done appropriately, it can give you anywhere between 8 and 30 points.
Oh, wow.
So it is very important, especially if somebody's on the crux of qualifying for either a better rate or qualifying in general for a program. And then there are alternative methods for for Equifax and for TransUnion. They don't offer a boost program like Experian does, but there are alternative companies such as, they have a company that will report your rent every month. And these are paid services. So Experian Boost is free. But if you want to report other things, there are companies out there that you will pay for the service, but they will report that for you. And the goal is that it's not permanent, it's temporary, just to help boost your credit score and give you a line of credit. during that period of time. And an alternative, if somebody needed to really boost their credit because they had lack of credit or they were overextended on their credit, is to ask a friend or a family member to add you to a line of credit. So if I have a $5,000 line of credit with Discover Card that I don't use, and it's been open for 5 years, if I added you, Joe, you would instantly gain my 5 years worth of good payment history.
Oh, wow.
And the fact that it has a zero balance would help offset the algorithm of the overall debt that potentially you're carrying. So there's a twofold in that. So friends and family, you can go and ask them to add you as an authorized user onto their credit card. They don't have to give you the card. You don't physically have to use it, but it's there for tricking the algorithms is the best way to say it, because you're secretly utilizing somebody else's good history to improve
Yes.
yours.
So listen, I could talk to you forever. You're a wealth of knowledge, and we share the same idea of educating our clients.
Mhm.
So does anybody else have any questions? I could just keep asking your questions all day, but I know that
You could, I still have time. I think also I want to touch on the business credit.
Yes.
What's
So
important. Mhm.
that was I have two other questions. If you want student loans, is there anything that people can do with them?
Sure.
And also, what's the process for getting separate business credit outside of your own personal credit?
Okay, so we'll touch on the student loan first. So I have a specialist that works at my company that handles all student loans. But as an overview, if you have been making payments on time, there are multiple changes to student loan debt relief. So the best thing to do is get out from behind it, directly contact your student loan administrator, whoever's handling that debt, and review your loan with them. You may be eligible for principal reduction, right? It's just included. It's part of the programs that have been implemented over the last several years. If you are somebody with student loan debt and you are in default, that will be held against you. You cannot put federal student loan debt into a bankruptcy. However, the student loan organization understands that sometimes people just can't pay. So again, getting out from underneath it, there is an income-based program for student loan debt. So if you owe $80,000 from a master's degree that you've never used, and you're angry, but you still owe the 80,000, and the reality is that master's degree, you're now a preschool teacher and you're just not making the money you thought you were going to make, you could do what's known as an income-based program with your student loan, and you have to renew it every year, but it will keep you from being marked in default and it will take you out of default. So it's kind of a win-win. So even if your net after all your expenses shows that you can only afford $50 a month, the student loan organization will give you a payment for $50 a month, right? So it's income-based and it's allowing you to not have your debt in default. So that's in reference to student loans. Susan just sent a message. How do you get debts that have been written off, removed from your credit report? So I'm going to do the best I can to address that, Susan. So number one, if you have debts that have been written off, it's important to know when they were written off, because there is a statute of limitation for how long they could actually stay on your credit report. And from a federal, that is 6 years. New York State just recently passed some new legislation. And for example, now if you have debt that's more than 3 years old and they have not collected, it's not that it's uncollectible, but it's uncollectible, right? There's a new statute of limitation that's saying that if you haven't collected your debt within 3 years, it's no longer collectible. If you've paid off the debt, it was written off, depending upon the creditor, you may or may not get it written off. So if you have a write-off, for example, it was a charge off from Bank of America, the chances of Bank of America taking that and permanently removing it is going to be limited, because there's already an acknowledgement there was been a default. So it would be different if there was no acknowledgement, because then you could actually prove and fight different methods legally in reference to that debt. So if it was paid off and you just want to get it off your report to put it behind you, if it's any major creditor, chances are until after the statute of limitation of 6 years has expired, you will not get it off. However, it's important to also know anything that's been written off, even if it was paid, really only affects you for about 24 months. Credit is based on an algorithm of the expectation of you making payments going forward, just utilizing a little bit of your history. So if you have charge-offs, collections, late payments, and they're more than 2 years old, chances are they're not impacting your credit as much as you think they are. And if they are written off and you did not pay them, again, monitor that statute of limitation. Don't make a lump sum payment to a creditor if the statute of limitation is around the corner. But if you are given the opportunity to settle that debt, again, depending upon the creditor, you could ask them, if I pay you, will you delete? And that's your magic word. Will you delete that data from my credit report? So you could ask them that during negotiations.
Awesome.
Okay. And
All
then
right,
your
so
other question,
business credit. How do you-
business credit. So it's important, obviously, a majority of the people I would assume that are on this call are business owners. And it's very common and customary for business owners, especially solopreneurs and smaller companies, to rely on their own personal credit to make business decisions. So obviously, what we would like to do is educate you about creating a shift. And the shift is understanding how to use business credit versus personal credit, because you don't want to mix the two, right? You're a CPA. It's a lot easier if everything's built under the business than, a client saying, well, this transaction was personal, these 5 transactions were business, and you're mulling through receipts. So what's important is that if you have a business, make sure that you have a Dun & Bradstreet number, right? So you can go to dunandbradstreet.com and you can register your business and get what's known as a D&B number. D&B,
That's free, right?
it is free. There are paid programs for Dun & Bradstreet where they will actually help you build your business credit, but I don't think that most people need it. Then I usually recommend, if you have a new credit, and you're trying to build, then you would go to Staples or Office Max, right? And you would apply for a small line of credit card in the business name, because that data will be reported under your business. They
Right.
will ask you possibly to do a personal guarantee, but you really only have to worry about that in the event of a default. The other thing you can do is you can go to Experian Business. Again, that's also free. And you can start creating your profile. Same thing with the BBB. So between the BBB, Dun & Bradstreet, and Experian, you could start building your business platform. If you are a bigger company, you may want to start building with LexisNexis and some of the other data providers. And by having an account with them, as you have terms, right? So think about your net 30, as you develop relationships and you have terms with your vendors, you could actually upload your personal vendor contact information, which they will verify, but that will help build out your business profile. But
Awesome.
moving forward, if you want to then get a business credit card or you want to get a business line of credit, you don't have to rely on your social security number. You can rely on your tax ID number, and you can start building business credit and shift the liability.
Yeah, that's definitely important if you want to be in business for the long term. They'll still ask you for a personal guarantee, but it won't go on your personal credit.
Mhm.
So that was, thank you so much for joining us. Just what kind of clients are you looking for that work for you?
So really, if you have a pulse and a heart, and you have a problem, just reach out. We're here to help. We have a
Anyone
great
that drinks
staff.
water, anyone
So,
that drinks.
what happens is that anybody over the age of 18 really will have questions. So you have people that will reach out because they're worried about their children going away to school and getting those teaser credit cards, because they're signing up in student union and you have 3 or 4 banks that are there to say, welcome aboard and, apply for our credit card, apply here, apply here. So we have a lot of people this time of year that reach out because they want us to really educate the their family members about the importance of being financially savvy when they go away to college and not
They
making
don't,
bad
yeah,
choices.
they don't teach this stuff in school. They don't teach you really about the time value of money,
No,
about credit card debt. And, people come out of college, they'll come out with an MBA. I've had clients that are highly doctors, okay? Not just medical doctors, but doctors that run businesses, and they don't know about this stuff, and I'm
no.
flabbergasted. I'm like, how do you not know? I just assume. That's why I said at the beginning, I don't.
I'll tell you, I'm going to tell you something funny, and maybe it will make sense to you. Most of the clients that we service are middle to upper middle class, if not beyond. People that don't make a strong living are very aware of their expenses and their dollars. So they're generally not clients for us because they're very aware.
Wow.
It's when
They're
you
counting
get,
every dollar.
yeah,
I
so
see.
it's
I
when
could
you
see
get
that.
into the higher income brackets. I have clients that make millions of dollars a year, but
And
they
they
don't
spend-
manage their credit.
I
And
could see
there's
that.
no direct correlation. You could make $10,000 a year and have an 800 FICO score, make $8 million a year and have a 500 FICO score.
I've seen that.
Mhm.
I've seen that so many times. That's amazing.
So it's all relevant, but clients for us are people that are having a problem. We're here to problem solve. Again, action plans are free. We do not charge for our initial consultation and advice. We only charge a client in the event that they understand that retaining us for service makes the most amount of sense because they are too emotionally involved in their own transaction to actually pull the trigger, right? Those are usually our clients.
Awesome. Thank you so much, Rhonda. I appreciate it. And we will be in touch about your projects.
You
And
got it.
definitely we will be sending you a lot of our budget needing clients.
You got it. Well, here to
Okay.
help. So
All right.
enjoy the rest of your workshop. And if anybody has questions, you know how to reach me. Bye,
Yes.
Elizabeth. It was
Thank you.
nice to see you.
Thank
And
you.
bye, Joe.
Hi, Rhonda. It's nice to see you.
All right. So that was excellent. Let me make sure that I'm sharing the right screen again. So like I said, the first thing is you heard it from Rhonda, it doesn't matter if you're rich, not rich, whatever, but either way, you have to, it should be, I believe it should be a course in school, how to check your credit, how to keep your credit up there, because people just don't know. They just don't know, like the credit utilization. I had a lot of questions for Rhonda, and like I said, I would have never stopped, but just keeping your credit under 30%. That's huge. I did what Rhonda did one time. I didn't realize I was using one credit card and only had a $500 limit. I was using it. I said, I'm only going to use this for personal. And I used it. I lost track of it, and I actually maxed out on it. My credit score dropped like 60 points. And I was like, are you kidding? And I paid it off right away. I was like, man, you banged me right away, but it took forever. It took like 4 months for my score to get back up there. So now also, what she was talking about, business financing. And you want to get the stuff in line before you go for loans. That's the most important lesson I'd like people to walk away with here. You start preparing to get your financing before you need it. Okay, I had a client, one of my first clients taught me a lot of stuff about business. And he had a quote. He said, a banker is somebody that wants to sell you an umbrella when it's sunny out. And then when it starts raining, they take it away. Okay. They don't lend people money that need it. And it's like they smell blood. They smell blood. So what you want to do is you want to have, if you're in business, you always want to be prepared. And you'll hear from Logan about how he does it. But you want to have your financials. And again, it's like Elizabeth said, if you don't have your books up to date, forget about getting financing. Okay. And if you go for financing, you're gonna be paying a much higher rate. Okay, because you're going to go to like one of these, oh, you don't need tax returns or financials. We'll just charge you 30% interest. Okay, also your presentation. So Logan does a whole presentation. He gives them his resume, his business plan. That's not even asked for by the banks. So they want to know who you are. So don't even wait for them to ask. Put it all together. And also what you want is they want to know who they're lending to. So it's just like you're getting a client, they got to know, like, and trust you. So you got to build up that trust. This is why I usually tell people, start your business, get a bank, a small local bank. Okay, because you might actually get to meet the president. Okay, you go to Chase Manhattan Bank, they shuffle their people around. You might have they'll call them, oh, I have a personal banker. If you put enough money in the bank, you'll get your own personal banker, and then they move. So you want to go to maybe a community bank, but somewhere where you actually know at least a bank manager. Okay, that makes a big difference when you want to go applying. And the application, don't rush into answer all the questions, and make sure it's neat. We have a team member, she has a daughter, she won a penmanship award. She's only 5 years old. I was actually looking to hire her to handwrite our I don't see anything wrong with it, but anyway, she had such good handwriting. I was like, oh my God, she writes better than me. But if that's not an option for you, just make sure when you fill out if you have to type it, then type it out. But penmanship does count, believe it or not. Now, the types of financing, this is extremely, extremely important, because like Elizabeth was saying, she has a friend that took out a loan, probably took out a term loan. They're paying, even if they're paying, let's say 6%. Okay. That's a pretty good deal now for a term loan. I was just talking to a banker, and he said mortgage rates are like 5.5%. People are saying, oh my God, well, it was 2%, 3%. Well, when my grandparents had a loan, the mortgage rates were like 19, 20%. That's what they were when Jimmy Carter was president. I don't know if Elizabeth was even born yet, but but yeah, I was like, and that's
No,
why.
Joe.
So yeah, that's the truth. So imagine interest rates. People are going out and getting mortgages. You know what that does on your interest rate? So if you're going for a mortgage now, don't be so 5-6%. That's still pretty good. If you locked in a 30-year mortgage at 3, the banker actually had a 2% mortgage. I was like, oh, but he's a banker. That's like me doing my own tax return.
Well, that's okay. That's where, Joe, it's important to shop around.
Yes. So, and it's funny, Elizabeth, because it always comes back down to the relationship. You want to have those relationships. You don't know when they're going to come in handy. But so a line of credit. So let me explain what a line of credit is. If you have a business, you need a line of credit. Now, preferably, you want one that isn't going to charge you any kind of annual fee, because all you want is a $5,000 line of credit under your business name. Okay, if you can get one that isn't, so like what Rhonda said, and I'll be transparent here, I know about this, the Dun and Bradstreet. I don't have the Dun and Bradstreet. Elizabeth, can you apply for that after the?
Yes, Joe.
That's the benefit of having team members. But listen, there's a lot of stuff to do when you own a business, but this is all preparation. So a line of credit is something that you only pay the interest when you use the money. So I've had clients in the construction industry. That's lines of credit are a must. Okay, you don't want a term loan. You want the line of credit for the next big job that you get. Okay. If you're a homeowner, you want a HELOC. Why? Because the HELOC is you want to do improvements. You don't need to refinance your mortgage. Okay, you get the line of credit. Also, if there's an emergency, okay, you got the line of credit that you can tap into. Term loans, like Elizabeth said, long-term financing, I believe, is for long-term assets. Okay, if you want to buy a business, okay, that's you might want to get a 10-year loan. Okay, you want the term of the loan to match the asset, if that makes sense. If you're getting an equipment loan, so those big trucks, those things last forever. Okay, what my client was doing, they had a bunch of trucks. They would get them, they get a 5-year loan, they pay it off, and then they would refinance it again. Okay, that wasn't actually good. They didn't run a good business. They never had cash. They paid all, the owner and all the it was a family run business, so they all took 150 $200,000 a year salaries, and that's why they were always refinancing their trucks. So like I said, there's good financing, there's bad financing. Now also, they were in leases. Okay, so leasing is another way to finance. What's the difference? The leasing company, you don't own the equipment. The leasing company, it's like renting. Okay, now sometimes that's good, sometimes it's bad. Okay, if you're going to buy a car and you want a new car every year, you're probably better off leasing it. Okay, why? Because when you buy a car, it depreciates before you even drive it off the lot. It's worth less than what you paid for it. If you're going to buy a car and drive it until you have 200,000 miles on it, you want to buy it. You don't want to lease it. Okay. Also, when you do that, you want to take into account if you're going to buy a lease a car, you want to see, like Elizabeth said, read the fine print in the contract. Leases usually come with miles. So you might pay a little bit for the lease, but then you find out once you go over 6,000 miles, you're paying like $3 a mile. Okay, so you want to be careful with that. There's industries that finance their accounts receivable. Now, this is a very, very expensive way to finance your business. Okay. People in the garment industry do this because they have to. What they do is they'll get a big order from a major department store, let's say, but they got to buy the material, they got to make the clothing, but they have a high profit margin. Okay, so that's in the industry, that's normal. Now, I had a client once, they were in the home health care business. Okay, they had people that went and took care of people. Susan knows this. She was a nurse for 90 years. But people have home health aides now, so that was their business. Well, they were buying other people's business that had accounts receivable. They would buy the business and then factor the accounts receivable. It was borderline illegal. Okay, you're not supposed to do that. A lot of the accounts receivable were from Medicare and Medicaid. They wound up in a heap load of problems. Not only they went out of business because the interest ate up all of their profits. Okay, so they were doing, so you want to watch out for factoring. That's what accounts receivable loans are. And then you can get these other, which I believe I added this this morning when I realized I didn't put this in there. They have these credit card loans. Okay, they charge you like 40% interest. People don't realize it. And what it is, it's based, if you have a restaurant, you take a lot of credit cards. So what they'll do is they'll give you cash against your credit cards that are coming in. And when the credit card money comes in, they take it. They'll take a big portion of it. A lot of the restaurant owners don't, because they're not educated in interest, and these started coming out, I think about 10 or 15 years ago, and I couldn't see how they were even legal. Okay. There's also now, and these are what Rhonda was talking about, the business loans. Like you can get a loan from PayPal. PayPal, if you're using PayPal in your business, they will give you a loan based on your activity. And I did that about 2 years ago because I found out it doesn't affect my credit score. So I needed to tap into some money. And what they did was they just took money out of my account every week. Okay. But it was good because I got cash, I needed it, and it didn't affect my credit score. Let's see what else. When to apply for financing. Okay. You don't want to apply until you actually need it. Okay. And when I say need it, you're ready to pull the trigger. Okay. Unless, like I just found out from my bank guy, I'm looking to buy a piece of property, and he said you can get pre-qualified. That's not the same. Okay. Mortgages are not the same as regular business financing. Line of credit, you want to apply for right away. Okay. That's not the same. But if you're buying a piece of equipment, and that's when you're going to actually pull the trigger and apply. Now, sources of financing. I had a client that financed himself. He had a home equity line of credit. He had a construction business, and instead of going to a bank and getting a line of credit, he used his home equity line of credit, which is perfectly legal. You can do that if you have that option. Okay, so he self-funded his financing. Now, also, what you don't want to do is you don't want to use all your cash. Okay, that's not smart. You want to hold on to your cash. So you got to do this wisely. Okay, that everything that you do is about, you got to educate yourself. You got to make sure you have a good credit score. If you don't have a good credit score, you're going to pay for it when you go for financing. And I lost my train of thought. So banks, okay, obviously banks lend money. Okay, that's one of the main ways that they make money. Okay, a lot of times you go to the bank that has your money, they'll lend you money, and they're lending you your own money. But you can obviously go to banks. Now, banks, like Elizabeth said, you could shop around. Banks have different programs all the time. Okay. Credit unions, that's one of the, I said, you want to go to a community bank or even a credit union. Okay, they give loans. Hard money is like, that's hard money. You go there when you can't get any loans, you're going to pay a lot of money. Now, real estate investors a lot of times will go to hard money lenders if they're doing something like flipping houses. Why? Because maybe they can't get a line of credit from a bank. That's a better way to do it. They don't have good credit. Or they come up with an unbelievable deal and they need the cash right away. Okay. There's other sources of money. Believe it or not, unions will lend money because they have a lot of cash on hand. So there's not just banks. You can, look around for other financing sources. Elizabeth, did you?
Well, like the SBA does lending, right? And
That's right. That's right.
isn't there's this insurance, that like life insurance that you can have that will also lend you money off of the life insurance.
Yeah. So the SBA is another source. They have, lines of credit. They have SBA loans. Now, our banker friend does a lot of SBA loans. So I would you got to go to somebody that knows how to do it. There's a ton of paperwork. But a lot of times it's worth it because now the SBA actually won't give you the money, or although I think they might have changed that. I used to do a lot of SBA loans, but what they do is they guarantee the loans. So what you might have to do is go to a bank that is an SBA approved lender. But the SBA right now, because of COVID, they loosened up their lending requirements. So the SBA is definitely a good source. And like Elizabeth said, there's people that have life insurance that has cash value. So that's actually another way to self-finance. And that's actually how, I think the Rockefellers did it. There's a book called, What Would the Rockefellers Do? And they built a fortune on whole life insurance. Because when and there's other people who I don't want to mention here, but what they do is they finance businesses with their insurance, with banks, and they don't have to report income. So, you hear about a lot of these rich people that, oh, they don't pay taxes. Well, they don't pay taxes because a lot of them are using creative financing. And that's the truth. Now, this guy, Logan Rankin, we met him a couple of weeks ago. He was on a podcast of mine. He agreed to give us some of his really good info. Oh, so somebody asked, do unions usually have better rates? No. First of all, you got to know somebody. It's not like you can, go into the classifieds and find union money, but they don't give better rates than banks because they don't have to. Sometimes they'll make loans available to their members, people that are paying union dues. I'm just saying that that's another option. That's more like a hard money loan. And what the unions are looking for, they're looking for a big return because they got, I don't know if you remember this guy named Jimmy Hoffa, but he got into a lot of money giving loans to people to build up Las Vegas. I don't recommend going to people like that for loans, but it is. Also, don't go to your friendly neighborhood bookie. That's another source of money, but that's what they call really hard money.
Yeah, that's dangerous money, Joe. This is where business plans help. It helps to show that what you're going to invest on is going to bring back a return on your investment. It helps to be able to work with established institutions where the money is either through the SBA guaranteed or with the banks. You have some type of assurances or reassurance that people aren't going to bang down your door. There is no such thing as debtor's jail unless you commit fraud in some way, shape, or form in getting this money. Even as Rhonda said earlier with the school loans. So school loans, you can't get them wiped away from bankruptcy, but if you do that payment plan based on your income and you do it for so many years, well, don't you know they are forgiving those loans after doing those payment plans for so long, but you will get that 1099-C. This is the whole thing. When people will forgive the money or forgive the loan that you've gotten, when you get a loan, it's not considered income. But the moment that it's forgiven and you don't have to pay it back, it does become income and you do have to pay taxes on it. And that's the whole 1099-C thing. But this is where I want to show the video of Logan because he talks about the importance of really getting things in order. You keep mentioning it, how he has this positive relationship with the bank. Well, how do you create a positive relationship with the bank? And that has to do with your ability to be transparent.
Yes,
right?
absolutely. So yeah, we do. I do want to answer. Lisa had a question. She tried to apply for a PayPal loan. You might not. It has nothing to do with your credit score. What PayPal is looking at are, do you use PayPal to bill your clients? And they're going to give you a loan based on your monthly billing. Okay, so I don't know why they would have refused you. But if you want to, what I would suggest is book an appointment with Rhonda. Okay, because she could definitely help you with your credit score. And she's got another thing that we didn't get to, but she's got a lot of credit sources. Okay, I go to her. I have a couple of my own sources. She's one of them. But she definitely has a lot of people. She's connected with a lot of mortgage lenders, hard money people, but I would definitely, if your credit score is low, you definitely need to start with her and get it up there. But Logan, so he's an interesting guy because for a lot of reasons. Number one, I'm pretty sure he's OCD because but he uses it in a positive way because I'm like, oh my God. And so in 8 years, this guy went from, he put $20,000 down on a single family residence because he did his calculations. He said that 20,000 was going to produce $360 a month in positive cash flow. And that, what he looked at was, if he took $20,000 and invested it, he was never going to get that kind of cash flow. And that's one of the ways he looks at financing. He took that in 8 years ago. Now he has, we just spoke to him. It's not 1925. He's going to have over 2,000 apartments. So if you're looking for an apartment in Wyoming, because that's where he is, you want to, because and I'll let you listen to him. It's about a 10-minute video, I think. Elizabeth, what do I have to do here? Stop my sharing?
Yeah, we'll just stop you from sharing.
Okay.
I shared a link to his book real quick. So if you want to check that out, I recommend reading it. I've started reading it. Joe's been reading it. It's kind of not kind of, it is interesting, especially since he was able to achieve that financial freedom so quickly. Right? 8 years in the long run is not that long. No.
No way. So,
So
okay.
hold on. I'm gonna share the, you know what I did, Joe? I didn't share my sound. There we go.
And which is what you tell everybody else that shares.
I know, but this is where if you make mistakes, guess what? You can amend things. Welcome to Bedrock Business Builders interview of Logan Rankin. He's going to help us talk about financing. He's going to help us talk about how to get prepared for loans. He's going to help us talk about the nitty gritty of really getting what you want while you're investing in different things. Okay, Logan, are you ready for that?
Let's do it.
I know in your story, you said you had $20,007 in the bank and you took 20,000 out and made your first investment. So you didn't buy a house for 20,000, so you had to finance the rest of it. So can you tell us about that?
So for my first property, I put 20% down on a single family home as my first investment property. And I was able to leverage, actually it was 25% down. I think I bought it around 75, 80,000. So yeah, it left me with $7 in my bank account, but I was able to buy a product, right, significantly more than my $20,000 investment. And I think that's where people get confused. Let's, just to compare, this is what debt can do. If you understand how to use debt to your advantage and you buy a deal that cash flows and that you can run, let's just say my first investment property was 100,000, right? If I bought $100,000 stock and I bought $100,000 property and both go up, right, by 10%. Well, that means that I gained 10% of my stock, right? Because I have $110,000. But on my property that I put $20,000 down and went up 10%, now my property is worth $110,000. So $20,000 investment for a $10,000 return is a 50% return on my money. And that's where leverage becomes really, really powerful, because in one investment tool, like a stock, you gain 10%, and in the other one, you gain 50%. And we're not even talking about the tax advantages, and we're not even talking about the cash flow. We're just purely talking about the debt. So I think there's a lot more creative ways to be able to do it. And there's a lot of different ways you can utilize debt too, but that's in itself why debt is so special.
How did you prepare for this? Because this is what people say, oh, I'm going to go into real estate, and they find a place and then they'll call me and say, oh, I need to get a mortgage. They haven't looked at their credit score. What do you do to prepare to get a piece of property?
Yeah, I think the first thing you need to do is you do need to have some sort of, like, I don't ever encourage somebody just to jump in and buy an investment property but I don't think you need as much skills or expertise as that keeps people from buying it. So it's somewhere in the middle. So what I did is, honestly, the only thing that I did is I read a half a dozen books, read 6 books on real estate. And what I did is in one of the books, I remember talking about how to underwrite a deal. So how do you look at an investment property? How do you find out what the rent should be? Which is not that complicated.
Okay, so you did your homework, you find the investment property.
Yep.
Now you got to go for the mortgage. Now you got to get the financing.
This is where I think people make a lot of mistakes, Joe. And I'm glad you asked this question, because I feel like this is something that I've been able to learn and do really, really well. In the beginning, when you don't own any properties, it is going to be the hardest. Okay. But you should be organized and you should be prepared, right? Most banks, you could read in any books, they're going to ask you for 3 things. They're going to ask you for your last 3 years of taxes, right? And they're going to ask you, and they're going to look up how much you make and your credit score. And then they're going to want to know your PFS, which is your personal financial statement. Okay.
Is there like a formula people want to see? Okay, here's I know you need a good credit score, right?
Right.
But this is something, there's an actual formula that if you know what the bank is looking for, you're ahead of the game.
Yeah, it's debt to credit ratio, and you want to be 125%. What they're looking for. They look for that in real estate, and look for that personally, which means that, you have 25% more income coming in than what your debt load is. That's where the 125% makes them feel comfortable.
Now, are they looking at, okay, because you're going to get on to the next step where you start building on more properties, but are they looking at your entire portfolio, or are they looking at one deal at a time?
So they're looking at both. So they'll look at your entire portfolio. They'll look at outside of your portfolio, your personal financial statement and what that looks like, which it sounds like this client was talking about. And then obviously the deal itself as well too. So it's really, really important to track your debt service credit ratio. In fact, for me, I track that monthly as well too.
But now, okay, so now you're on to your second deal, and your financials, your PFS is going to look a lot better, because now you already have a piece of property in there. You're showing positive cash flow. Your net worth is going up. So what's the next step? Because it sounds like it should be easier.
It does get easier. Before the next deal though, this is the step that everybody forgets. Once you close on that deal, this is, it took me a while to learn. So this will be gold for your audience, is you do not ever let the bank ask for another piece of information. You write a reminder every single quarter and you update the bank. I pride my banks never ask me for my taxes. I send it to them before they ask. My bank never asked me for my personal financial statement at the beginning of the year. I send it to them first.
You only deal with one bank, or do you have a bunch of banks?
I have a bunch of banks.
Okay.
Yeah.
So because all the banks are really different, right?
They are. And you need different things from different banks. So as you continue to scale your portfolio, you should be looking at banks for different things. And every bank has a niche, right? Usually there's not a bank that can do everything. So I have different tiers of banks. I like a initial bank, a middle bank, and then my end game bank. And I look at them for all different reasons.
I'm sorry, but do you go to them like they all have an application? Here, fill out the application, give us 2 years. They're going to ask you for all this stuff. Do you actually go in there with like a package? Here, I already have this. Do you have like your resume and your
Yes,
finance?
I do.
You have a resume in there.
Yeah, I did. I had my resume in there. I had my background history on there. I had my W-2 stuff in there. And then eventually it was less about me. Like when you start acquiring properties, like they don't look at my credit score anymore. They don't even look at like any of that stuff. Now what they look at, if you have enough experience, they're just looking at the deal itself. Like on bigger deals, they don't actually care about you. They care about the business that you're buying. And if you're buying,
I have to admit that you answered a fair amount of questions. However, what types of loans did you use and what are hard money loans? Because people talk about that in real estate and it's hard. It's a hard concept, I think, to understand.
yeah, for sure. Typical banking or financial institution that I'll use to be able to buy my deals are either local banks or community banks, as well as credit unions. And I do that, guys, because I like to buy deals that are value add, which just strictly means I'm buying the business, but I feel like there's a lot of room to improve the business. I want to use a smaller bank, which is usually more relationship based, so that they'll look at the property and trust what I'm going to be able to do with it, which helps me get a little bit more creative with financing. They also, most of the time, won't charge you a prepayment penalty. With the blessing of the bank, of course, because you want to make sure you're being honest and transparent. No bank wants to necessarily lose debt. As long as you're able to replace that for them and be honest about your plans. And then I like to move it into agency debt. And that's the last step for me. In agency debt, I'm talking about Freddie or Fannie. It's long-term fixed financing. Their rates are way better than local and credit unions. They're usually local and credit unions will only do about 5-year ARMs and 25-year amortizations. Hard money now. So from hard money, and by the way, I'm actually launching a fund, a hard money fund. And if anybody's interested after this, they can email me at logan@loganrankin.com. It's actually launching July 1st. But hard money is amazing because real estate is really tough when you own it. And when you own the real estate, there's so many different advantages. And you mostly get into real estate for the cash flow. And you definitely, at least that's what I did. And there's ancillary benefits, which we talked about already today, which is obviously there's some appreciation over time. There's also significant benefits tax-wise, which Joe would explain from a depreciation standpoint. But there's work. There's a lot of work with holding real estate. So hard money is basically where you give your money to a hard money lender, somebody that has proven, that has experience. He takes your money and then he in turn loans it out to people that need the money rather quickly and don't have enough time to be able to utilize a bank, for example.
Yes.
Maybe
one thing that really got me was when you talked about the real estate business and you said that you want to make it a great living experience, I think, for your tenant.
Yeah, that's one of my biggest goals right now, guys, is I actually wanted one of the biggest visions for me that I want to disrupt property management across the United States one day, starting with my home state of Wisconsin, because I believe that people pay rent and they're paying good rent these days. They deserve a place that they can be proud. They deserve a place that's safe. They deserve a place that gives them the experiences that they're looking for. And
awesome. Thank you so much, Logan. If you want to connect with Logan, it's what is it again?
Logan@loganrankin.com is my email. Otherwise, my website is the same thing, loganrankin.com. And you can follow me on all the social media sites. My goal is to give away as much free content as possible this year.
Awesome. And can you hold up your book one more time?
Yeah.
Yes. Find Your Financial Freedom. Highly recommend it. Thank you so much, Logan. And we will be, we'll stay in touch. All right. Thank you.
Thank you.
Awesome. So, yeah, I really like Logan. He's the only, and I've known plenty of people in the real estate business, he's the only one that's ever said that he's focused on his tenants' experience. And I think that that's key to why he's so successful. Okay, and that's why I said if I ever move to Wyoming and I need to rent a place, I'm gonna go to his place. It sounds like Disney World for renters. So
Oh, it's Wisconsin.
that's what I said.
You said Wyoming.
Yeah, same thing, isn't it the same? Okay. That's why I have people here to check me. Sometimes I'm wrong, people, and I'll admit it. Can you see my screen here? Okay, good. Because Dora asked a good question. How do you know uh, what kinds of loans the different banks offer? So I've spoken about our loan friend. His name is John. He's been in the loan business for as long as I've been in the accounting business. Okay. So when I go to him and I say, okay, I got this client that needs this kind of loan, what do you think? So he's done all the legwork. Rhonda has a whole bunch of different, because all the mortgage banks, if you're going for a particular type of mortgage, some of them like giving people that have low credit scores but high income. So that's when you use a broker. They get points, but they got to earn the points. Like any other industry, there's bad loan brokers, there's good loan brokers. That's why if you have somebody like me, I'm not going to send you to a bad person, because we vet them. So I only have a couple of people that I would refer our clients to. Otherwise, I would not refer them. What you got to do is you got to do your own research. You got to do your own legwork. Okay, that's not always easy. That's why you should get somebody like Elizabeth. Elizabeth is great at doing research and going right down to listen, who's running the bank? Okay. Who are these people? You don't want a bank that has a revolving door. You want somebody that's going to be there. You want a long lasting relationship. And it's the same thing with loan brokers. If you're in a business, especially if you're in a real estate business where you're going to have to keep going back to people. And it's funny because it always comes down to only a couple of things. You got to have your finances in order, and you got to have the right relationships. So I think that's all we have on loans right now. I'm going to go into our program. If anybody else has any more questions, you feel free to put them in the link. You can always make a schedule a chat with me. It's what is it, Elizabeth? Timewithjoe.com.
It is timewithjoe.com, because that's what really, when you schedule time with Joe, you get that one-on-one experience, and he can really help you go through a lot of different things. And this is where what we're talking about with the CFO program that we have here is, it is about getting things in order. It is about getting that portfolio or that file together, right? Because you don't just want to have a bank account, have a credit card, and have that information without knowing what your income actually is, what your return on investments is. You want to reconcile your accounts based on your business. And that's what the CFO program really does. It makes it so a CFO is a certified financial advisor or officer, right? That's what Joe is. When Team Bedrock is able to reconcile your accounts and put them in order, and you get a profit and loss statement each quarter, you can then go through and you can financially plan what you want to do within your business and within even your own personal life throughout the year. A lot of times when Joe is just doing taxes for individuals, he would see that they made a huge purchase, like they purchased a home in cash, or they purchased a car, they did something that made it so all of a sudden they had to pay a huge tax rate. Well, now, if you are chit-chatting with us and working with us on a monthly basis to do your bookkeeping and accounting, and you are talking with us quarterly to financially plan, that makes it so you lower your tax rates. You lower the amount of money that you're going to pay in order to use your money or to profit off of your money, because you are, as it says, you're taking control, you're reducing your stress. You get peace of mind knowing that Bedrock has your back, and that really we're your financial back office. So you don't have to work, what is a lot of clients that come to us and they have their bookkeeping and their record keeping on Excel spreadsheets. Now, We don't do bookkeeping and record keeping on Excel spreadsheets anymore. That's just not how it's done. We utilize the tools and the resources that are available to us to make it effective and efficient, and to make it so it's easy for you to pull that information when you need it.
I think thank you, Elizabeth. I think the biggest benefit for our clients is, yeah, like you said, they know that we have their back. We do focus on education. And more importantly, I think we know what they don't know. You know, they say you don't know what you don't know. And we don't want people not to know. And one of the things that thank you for sharing that new business startup checklist, because a lot of the things that we covered here are in there. You know, from chapter 1, you got to know your business. What are you selling? Who are you selling it to? Then you got to start with your budget. You know, people want to go into business and they just, oh, I'll just go into business without even knowing beforehand what their personal budget is. You know, so you got to take control of this stuff. And I think we not only educate people in this, but we give them the tools. We have all kinds of budget tools, petty cash, expense reports. And it's like Rhonda said, you know, if you're going to Starbucks twice a day, that could add up. You know, and that's why what we do for new clients, we offer 3 months free. Our CFO package starts at only $57 a month, but we want you to be comfortable with us. So we do offer a special to people that are in this workshop, or they're watching the replay. So I would definitely take advantage of that, because it's not just me. For a long time, it was just me. And I learned the value of having a team. So I consider everybody, all of our clients, as being on our team. Okay, we have team members and we want everybody to succeed. And that's how we go about our day. You know, just like Logan likes to have a great experience for his tenants. And that's not all. Elizabeth will gladly send you a copy of our itty bitty S Corp book. And what we found is a lot of people go into business, they don't know about the benefits of being a corporation, or they go in and decide to become an LLC. So in this book, I explain very simply why S Corps are the entity of choice for small business owners. And that wraps up the presentation. Thank you. If you want to connect with me, you can go to Time with Joe. I love talking about business and helping people find the money.
There you go, Joe. Thank you. I will also say that we meet for a mastermind on Fridays from 11:30 to 1. Since you are now on the mailing list, you will get invited to that on a weekly basis. Come share your experiences, ask burning business questions. If you want to see the full interview of Logan, here is that full interview. We did upload it to YouTube. As you could see, it was cut.
Yeah, we only had like 10 minutes, but I think it was like 30 or 40 minutes. We really dug deep into a lot of his thing. And you know, his book, surprisingly, I'm more than halfway through it, and he doesn't even talk about real estate.
I know it's more about getting prepared to do the real estate,
Yeah.
and to commit to the idea of when you are seeking out financial freedom, you're going to make certain changes in your life. You might even change how you're driving to make it so you're lowering the amount of gas that you're using, right?
I've done that. Are you saying that because I did that?
I am saying that because you did that,
It's
Joe.
amazing. You know, I'm looking at my, and I said, oh, good, I'm getting 30 miles per gallon. And then as gas went on, and actually after we did the interview with Logan, I said, you know, what can I do? I'm not going to get low. I'm not counting on the gas going down again to $2 a gallon. So I changed my driving habits. do you know I'm getting 42 miles a gallon now? I didn't realize, when and they said this, I'm like, oh, some things you don't know, but some things you do know, and you just don't follow it. The amount of gas you waste at a stoplight, just pushing on the gas. So I just go slow now.
Well, an object in motion will stay in motion, Joe, unless there is a force that will stop it, right? So if we're driving a little slower and we're just going and using the brake less, well, that's to our benefit because the car will still move.
You know what else Logan said, which was key? A lot of people are afraid of numbers. They're not going to do the budget. People are afraid of looking at themselves, right, Susan? You're muted, but people are definitely, and so we struggle with that when we advise clients to, do their budget. They don't want to look at it. But what Logan said was brilliant. He said, you don't necessarily need to do the budget. You got to be aware. You got to be aware of what you're spending money on. I became aware of my gas when I was going, and instead of $30 every week, it became 50. So I had to feel the pain. Would you like to add anything to that, Susan?
Yeah, the pain is apparent when you go to the gas station right now. And when you see $7 a gallon, which is what ours is running at, $7 a gallon.
Oh, ours went down. It was only $4.79 the other day.
Well, they said something about it's going down, but now I think it's only $6.99.
Oh my God. So yeah, you change your habits, you start finding the money.
Or you just don't go anywhere.
You start walking.
We could use a bike.
Use a bike. Yeah, things that are, and, sometimes the bad things turn out to be good things. So
I've been walking a lot more.
change my drive. That's good. That's good, because how's your knee doing?
That's why I'm walking a lot more.
Okay. But you change your habits, you find the money. You're not going to find $500. You're going to find $10 here, $10 there. Don't go to Starbucks.
Pick up every dime you find on the street.
You can go to Starbucks and just sit there, right, and bring your own coffee. You can. I don't think they'll kick you out.
Joe, I wouldn't recommend that. Okay. But this is where it's been a pleasure spending time together. We're not going to keep you for the 2 hours. We're going to give you 14 minutes back. Okay. Usually we play a game. We play Jeopardy, or we play this. It's a Bedrockopoly game that I started doing, right? And we can do those during the mastermind. During the mastermind, we also ask burning business questions. It is a money mastermind. So we're there to chit chat about money, about financing, about all the different things that we might be a little uncomfortable about. But because we turn it into a fun and friendly environment, you're not worried about asking those questions. You actually look to ask those questions, because then you get the mind hive all to break it down for you. There will be a replay of this. If anybody has any further questions, this is where I'm going to say timewithjoe.com. It's easy peasy, lemon squeezy. Don't forget to do it. And I hope to see everybody again in the future. Toodles.
Right.
That's it.
Thank
That's
you.
our story, and we're sticking to it, right, Joe?
Thank you, Elizabeth. Thank you, everyone, for coming, and I hope to connect with all of you soon.